Welcome, folks. Hope you're all doing well. So today we're going to discuss two models. So we're going to discuss about the market maker buy model. Here we had a good example for the same. So here this is the price action for gold. This is today's price action. Also, we're going to discuss on the quarterly theory and part of the power of three. So today is going to be quite a comprehensive tutorial. So we begin off with the market maker model. So what you have to look in a market maker buy or sell model is simple. You want to see the market drop. For example, you're looking for a market maker buy model, like for instance, what you have here. So you want to look and see the market dropping prior maybe to New York. So as you can see, the market went all the way down. We had, this was Monday's low. We took that, and also we had an inversion fair value gap right here, as you can see. So we had two PD arrays. We had this low, and also we had the inversion fair value gap. So we want to see the market drop to a discount to a PD array that is on a discount. So as you can see, we went all the way down during London and Asia. We started off with Asia, went all the way down, took out that low, and then now we had a shift, a sentiment shift, and then we had this aggressive move to the upside. So what you want to look and see is the initial drop, and the opposite for a market maker sell model. So you want to see the initial rally to the upside. So could be aiming for maybe such highs. So you want to see that. If you see that, then now you anticipate for shorts. The opposite happens for a market maker buy model. So you want to see the market drop, take out a low, trading into an inefficiency, and then now you can buy from that. So here we had this low which got taken out. We had the inversion fair value gap. As we always say, the inversion fair value gap shouldn't be traded all the way to the, let's say, 25%, which is the lower half. So at least it should be traded to the midpoint, which is the midpoint of this inversion fair value gap. So as you can see, if you take our fib and see where price reacted from the inversion fair value gap, so you are having that. As you can see, we hit the 75% level. So that shows how price is respecting that level and the willingness that it has for it to reverse. So we had a low there. We had a shift in market structure. It left us a fair value gap. So probabilities are for such a fair value gap, it will be left open because the market is in a hurry and we have already traded into a discount, taking out previous day's low, and this is what we call a breakaway gap. So we are having the breakaway gap. We traded into it partially, which we also refer to as the institutional order flow entry drill. So we have that, and we also had a breaker. So we had low, high, lower low. We took out sell side. So this one automatically becomes the breaker. So you mark the up close candle. You mark the most up close candle. So that's what you mark. So we extend that through, and then you wait for price to move past it. So while we are down here, we know that this is a breaker. Immediately you know this is a breaker. So long as you have already taken out sell side, this one automatically becomes a breaker. So you mark that even prior to the breaker being traded into. So you mark that, and then now you wait if you have to wait, you could be buying below here, which is fairly okay. But if you want to like wait for the breaker, you wait. And as you can see here, we had a down close candle right here. So we had a down close candle which came all the way down, digging inside the breaker. Also, we had an inversion fair value gap inside the breaker, so you could have used any of them. So we had this as an inversion which price traded into, and also, as you can see, we traded partially above the midpoint of this inversion fair value gap. So, and as you can see, the time that the trade happened was around 7:15, which is around the New York open kill zone. So you capitalize on that. As price was digging inside the breaker, you could be going long inside the breaker, and then your targets would have been something like this. So you take your fib, anchor it from this high all the way to this low. So the midpoint, while you were down here, you were at discount, so you aim for something that is above the midpoint. So something like this high, you also had this high. Also, you could be aiming for such highs. So that would have been the draw on liquidity, aim for a premium array. So that is what we had. That is what we had. So for aggressive buyers, this would have been your entry, and then maybe adding some more into this gap, which is the institution order flow entry drill. And then now we have this beautiful run to the upside. So that was what's it. That is what basically a market maker model looks like. You want to see the initial run as a Judah swing, and then now the real move happens. So the same thing that happens to the power of 3. So the power of 3, as you can see, we have Asia session, we were accumulating. So we want to see the manipulation, and then now the distribution, which happened today as well. So there were so many things that you could have used to trade this day. So even if you didn't know about the inversion fair value gap, you couldn't miss such a low, because that is what price came all the way down to do. So it came all the way, took out that low, and then now we had this aggressive rally to the upside. So take keynotes at the lows and the highs, and then now if you see maybe a breaker, if you see an order block, if you see an inversion fair value gap, a fair value gap, all those you can use either of them. So you just have to note which one you're going to use. So like for instance, today we had that low and the inversion fair value gap. So you want to see if price really respects those prices. So that is it. You want to see the initial move being the Judah swing, and then now we have the real move. So that is the power of 3 also. We have the initial move being the manipulation, and then now we have the real move. Now let's talk about the what do you call it? Forgot. The other model. So initially we want to see, as I remember, we want to see either of them, either Asia or New York or London accumulate of some sort. So as you can see, we had Asia accumulating. So it was so definite that London will be the Judah swing. So you treat that as a Judah swing. Yes, you can trade this. We traded into this inefficiency, taking out that high, and then as you can see, that happened right at the top of the hour. So, and the true open for this day was, you mark the what do you call it, 12 o'clock midnight. So that's what you mark. So you mark the open, which is right there. So as you can see, we went above the opening price. So if you were to mark the opening price for today, would have been that. So that's the true open for the day. So you have to note that. So we went all the way up above the opening price inside of a fair value gap. Also we had another fair value gap right here. Also we had another one right here. So we could have used either of those. So we traded into that, and then now we had, as you can see, this was quite clear. This was a clear sell side that was residing below these lows. So you could be aiming for that, for the Judah swing. No problem with that. So here, what you want to see is Asia is accumulating, and then the manipulation happens on London, and then now you wait for the unicorn, which aligns at 7:30, which is the true open for the New York session. You wait for the unicorn to happen. So as you can see, we had this fair value gap, we traded back into it. That was your entry. We also had, if you were to wait, that was 8, so 7:30. So as you can see, we had this initial move first. We traded into this order block right there. We also traded into this candle. So this would have been your entry, or this as your entry. So it doesn't matter. So what you want to see is, you want to see first Asia act as an accumulation, and then London being the manipulation, and then now the distribution happens during New York Open. So that's basically it. I don't think, maybe if you need a more in-depth into the quarterly theory, that was the name I was forgetting. If you want to maybe an in-depth tutorial about the quarterly theory, maybe I can do that in a separate video, but I wanted to kind of like share what today gave us. So we trade what the day gives us. So as you can see, we had quite a number of trades. You could have capitalized on these trades. Also, you can be trading on maybe Asia, because like for instance, you won't expect that much of a volume, but you expect something, a measure of maybe a retracement, a measure of a move. But during Asia, we don't expect so much volatility to be in play. So as you can see here, we had this gap, we traded into that, and then we had this move to the downside, which began all these move from up here to the downside. So you could be trading during Asia. Just wait for maybe a lot to be taken out, aim for the previous day's high, and also you aim for maybe an fair value gap or any other PDRA. So I guess that's it for today. I'll do a comprehensive video on the quarterly theory, maybe over the weekend. I'll do that. So I hope you enjoyed this, and until I talk to you next time, be safe.